A very good morning and welcome. You're watching India Market Open and it's looking like it's going to be a positive morning. Niraj, sometimes the realization that you've seen a good thing takes some time. And we're seeing that overnight in the US markets, where they've taken a day to realize that Jerome Powell's Fed comments are actually positive. Perhaps you'll see that realization in the Indian markets vis-a-vis the budget as well.
Very likely, Tamanna. And you're right. I mean, the global cues with what Meta has done and, Mark Zuckerberg has turned the corner and how. But I know you'll talk about it in detail, but I was just blown away by what a turn of events the last 24 months have been for Meta. And could the last 24 hours be that turn of events, as you said, for Indian markets, simply because of, as you very rightly said, Tamanna, the realization that the budget could be decent? Because, and we'll talk about it after global cues, but privileged enough to attend an event yesterday which had some of the A-listers of Dalal Street, and the conversations out there about budget and markets were quite fascinating.
So Niraj is flexing.
I'm not flexing. I was just hearing.
He was invited to a very, very exclusive VVIP party where you get the best of the best views from market cues. It's great, and we get to hear about it.
That's the point, right? That we as journalists hear things from people and bring it out to our viewers, and somehow that access that you, I, and everybody else on NDTV Profit and other platforms have is quite unique.
Yeah, I'm pulling your leg. But yeah, we'll hear more about it. Let's come to why this is expected to be a good morning, and maybe just pull up the implied open before I get to the global cues to set the stage for what we're expected to see. Because what we've seen overnight is fantastic in the US, and yes, you're most likely going to see that kind of an open here as well. So what's worked? Look at Wall Street. Like I said, sometimes it takes time to understand what really the implications are of statements made, and a knee-jerk reaction then gets reversed. That's exactly what we saw happening overnight on Wall Street. And just very quickly, what a run-up you've seen across the board. The Dow nearly 370 points up. NASDAQ, of course, fueled by more than just Jerome Powell. And the big reason, really, that perhaps we've seen for the NASDAQ running up is, like Niraj said, Meta. Not just Meta. You have all the biggies doing very well. Meta, Amazon, Apple, all results a beat. Apple didn't do so well, though, in terms of the stock reaction, but Meta was the big fab picture. That optimism extends across the board. Just look at the 10-year. The 10-year is now below the 3.9 mark. It's a 1-month low on positive cues, with the realization that, listen, hey, for the first time, the Federal Reserve has actually talked officially about an interest rate cut in their meeting. So it's definitely on the table. Sooner or later, we'll know when it happens. And you still have 7 to 8 weeks till March. So who knows when? Of course, March is out of the question, but maybe May, June. So all of that is coming through as we see on the US bond yields portion. But Asian markets, we must pull up as well. Before I hand it to Niraj for the trade setup, Asian markets in fine fettle this morning. The Hang Seng almost 2% up. A quick look on what fund flows were like yesterday, because you had a muted end to the day, slightly negative, and you had FIIs selling to some extent, massively in the context of Indian markets now, maybe about 1,900 crores. DIIs were buying. But I think the real action perhaps on Friday, today, Niraj?
You could very well argue, Tamanna. Yesterday, for example, and you will hear that conversation when we play out the Madhusudan Kela recorded interview. An interesting point in that how much does an economy have the capacity to absorb? And because the next 12 months, or because FY24 would be marked by 2 months of Achar Sahita as well, wherein there's not enough moves undertaken, April and May, presumably, or at least April, if not May, and in some sense. So therefore, the Capex announcement of the numbers that we've given out for about 10-month or 11-month period is actually not a degrowth in any sense from the 30%, or maybe a marginal degrowth, because anyways the implied number is about 17-18%, right? Yeah. And on top of that, if you account for 11 months, even if you be very strict and say it's only 11 months, because only 1 month is lost in Achar Sahita and planning, etc., and stuff like that, it's still a credible 20% number on the back of a higher base. So that is one thing that he said. And just from a market's perspective, like you said, I mean, I thought instead of giving lines for the trade setup and numbers, just dwell for a minute, because we need to talk about stocks as well, but just dwell for a minute on some key learnings from, or key takeaways from some of the conversations that I had, you spoke to Vijay as well, and it'll be lovely to understand what he had to feel, because I'm sure we put out the show, but it'll be great to get that perspective. But just the belief that the budget has moved on from being a budget when people would nitpick about how the government will reach a particular number, because there always used to be a doubt that, oh, there's something out here which has not been revealed, something that has been kept hidden, etc., to a budget wherein people now almost unequivocally believe that if they've said this, they'll probably do this and maybe they'll over-deliver. Yeah. So I think that is one key factor from a budget highlight, and if therefore the market will come to a realization that if they are saying that they will do 5.1, because 5.9 was, they've overshot and said 5.8. So if they'll do 5.1, if they do lower than 4.5, then now fiscal consolidation as a debate is out of the way. And therefore, what else do you look for within that sphere? What is it that the government can do within the limited scope that it has? And can the other aspects, which is household capex, private capex, and monetary policy, join together to keep the cartwheel flowing? And I think that is something that almost everybody in the room, independent of whether they were bullish or bearish on the markets, because even if people were bearish on the markets, this point they had all acceded to. So that was one key takeaway. 90 people in the room, everybody unanimously saying that this is one aspect that is true, and almost everybody, Tamanna, saying that never mind this 1, 2, 3, 5% dip that may come at any point of time, from now at least until the election result or the budget, the July budget,
yeah,
people are constructive. There are some people who are saying we are buying the news and buying the rumor currently, or buying the flow currently and selling the news when it happens in May.
Yeah, yeah.
But everybody's bullish for now. Even if there is a dip, that probably will get bought into. That seems to be a unanimous feeling. Yeah,
no, so Vijay Kedia, who I spoke to yesterday, also had this point that now if there's a 1,500-point cut on the Sensex, no one really gets too stressed about it. So we're becoming a more mature market, and you might see a bit of cool off ahead of the budget, the next budget and the next election. It may come. But just another point I wanted to make, Niraj, and when you go back and look at all of the allocations more carefully, this is also reflective of a government that does not need to use the budget as an instrument to pander to voters. This is displaying a lot of confidence that you're coming back in the next election, and you do not need to use this as a speech to say, I'm going to give this to you, I'm going to give that to you. So that's really showing that extent of confidence. Now, how it plays out, of course, remains to be seen. But, let's get to what is specifically going to react this morning to the budget. And remember, yesterday you had real stocks down. There was no real clarity on what this budget means. You had real estate down. All of that may see a bit of a reversal, at least as far as real estate stocks are concerned, because Jeffrey's note on the budget talks about how interest-sensitive sectors actually will benefit from a tightening of the fiscal deficit. They, in fact, also talk about PSBs. PSBs were up yesterday. Public sector banks were up. And those who are looking at that kind of a story, a government spend story, would perhaps be more constructive on PSBs as well. Let's pull up the list of stocks which we want to talk about today, and which would look definitely interesting. I'm going to start with a real stock, Texmaco. They had numbers out, and the numbers by itself look pretty good. If you take a look at it, your revenues were up 43%, nearly 44%. On all aspects, you were seeing Texmaco that has done pretty well. In fact, your EBITDA was up 47%. Margins were up 24 bips, and that's an important figure to look at for a company, or for the rail pack, because sometimes their margins get hit, but their margins are pretty decent, and net profit also has done very, very well. So that's one that you would look at. But just to add over there, that the rail capex has gone up only about 2%. So how much of that is already priced in the entire rail pack is something that we will have to see. And remember, there were a couple of Jupiter wagons also had its number out, and the revenues were up 39%, EBITDA 55%, margins were very good for Jupiter wagons. So those two we should definitely look at. I would pick the TVS Motor, two-wheeler stocks as well, TVS Motors and Hero MotoCorp, because sales numbers were out, sales numbers were looking good in both of these. And we'll start it with TVS first. Take a look at the export number. and the two-wheeler number, both very good. So Jan sales up 23%, motorcycle sales up 29%, but the EV number and the export number was very positive. EV sales up 34%. You have to count for the fact that all EV sales now are on a relatively lower base, so they generally look good, but total exports up 22%. Now, a couple of things on the EV play. Your FAME allocations in the budget have actually gone down significantly. That's bad for newer players, but perhaps not as bad for incumbents. So we'll have to see how that pans out for Hero Motor as well, whose numbers were very good. And Hero Motor's export numbers specifically, which came out in Jan, were excellent. Their overall numbers up 22% year on year. That is motorcycle sales up 21%, but their export numbers and EV sales also looking very positive on Hero Motor. So that all in all is something that you should look at. Yeah, your export numbers were up 75% year on year. So these are a couple of buckets, I think, that we should have on our radar today.
Yeah, and then divvy up the numbers into good numbers and bad numbers. Maybe you started off with Texmaco or Jupiter Wagons, which were good numbers. Good, yeah, both very strong. Before we come to bad numbers, because there are a lot of them. Some good numbers. Tamanna will be talking to Indian hotels. Just wanted to mark, I mean, you could argue that some bit of it is discounted, but the best ever quarter in the company's history, highest ever revenue, EBITDA, margins, PAT. You've got to pay credence. Even if the growth is small lower on a higher base, the numbers look rock solid, so that is to be watched out for. There is SJS, which came in with an EBITDA performance, which was up 55%, 40 crores versus 26 crores. So watch out for SJS. Strong EBITDA performance, and usually the street is rewarding stronger EBITDA numbers. So watch out for SJS. Watch out for Abbott. EBITDA margin at 27% versus 23.9%. So that's, those from all the list of numbers that came out from amongst the good news, I thought these were the ones that stood out in terms of good news, because the others like Gokaldas Exports, etc., were in line. I mean, Rolex rings at 20%, 22%, you could argue they were in line. But Tamanna, a clutch of weak numbers, none more so important than Bata, but and there's a long list, but is there something that you want to highlight from amongst the weaker numbers? Because I have a really long list of weak numbers.
No, go ahead with the weak numbers. Bata, of course, looked like it was having a bad time, and that has been consistently continuing. So it has to be looked at on a relative basis as well.
Yeah, but you are right. But the lowest performance on EBITDA margins in the last 8 quarters. That tells you something, that it's not being able to bounce off. And relative to Bloomberg estimates for the quarter, there's a large miss that Bata has had. Yeah. So that is the problem for Bata. From amongst the weaker hands, this was weak. Emphasis was weak too. The revenue growth was marginal, if you will, but EBITDA miss, EBITDA margin miss, PAT miss. And at a point of time when we know that for Emphasis, the insurance piece in US is hurting. The good part is that they've maintained the margins in the band that Nitin Rakesh had mentioned the last quarter, but it leaves a bit to be desired. But, the 3 that stood out for me, Tamanna, most importantly, one, VST Tillers. Extremely shoddy performance. Sales down 20%, 170 crores versus 213 crores. It's not a high volume stock, so I don't know how much people can trade it. EBITDA margins at 5.6 versus 10.9, nearly halved. PAT down at 17 crores versus 19 crores. Volume pressure, margin contraction led by negative operating leverage. So that's one. And look at across the line items. I have some notes here. Tillers are down 53%, tractor sales down 32%, power weeder sales down 27%. So the start for Q4 as well for VST Tillers, they released that monthly data, has been very weak. January tiller sales were flattish and tractor sales were down 46%. So weak quarter and a weak start to quarter 4 kind of compounds the problem. So and then 2 more stocks before you come in. Sumitomo Chemicals, again, a very forgettable quarter. Sales down 28%, EBITDA margin at 12 versus 16%, and PAT down 40% at about 55 crores versus 90 crores. So that one was weak. And Aether Industries too, Tamanna, was weak. PAT was down 50%. EBITDA margin, hold your breath, 28% corresponding quarter last year, 20% this quarter. So massive margin erosion for a clutch of stocks overnight.
Just because you were talking about Bata, there's a Citi note on Bata that has reiterated a sell call, price target of 1340, and exactly everything missed. Your revenue, EBITDA, PAT missed. Even your GM improvement has declined. So some, effective pain over there. But of course, we'll get to more stock-specific news a little ahead on the show. Meanwhile, let's get the view, global sort of view on the Indian budget and what that means for markets and the economy. Mark Matthews, Head of Research of Asia at Julius Baer, is with us this morning. Mark, a very good morning to you. Great to have you here on NDTV Profit and the India Market Open. Let's begin with your take on the budget. Do you think the fiscal deficit outlay and the confidence with which the Indian Finance Minister is talking about sub 4.5% of a fiscal deficit in FY26 was a positive surprise?
Very much so. And I can't think of anything to say apart from what already has been said. I agree with what you said, and I think it is achievable given the strong economic growth and the high tax collection. And this is a positive, a surprising, it's a nice positive.
All right. What does it mean in terms of how India is now rated as an investment destination? We've, already seen an improvement in fund flows, etc. But does this sort of compliance or intent to comply to a tightening fiscal deficit infuse more confidence in terms of foreign investors?
Yes. The rest of the world is going the other way. The U.S. has a fiscal deficit, which is it's almost going to be above 7%, I think, this year. So this is a rarity in the world where the governments are increasing their tax collection, but at the same time the economy is robust, and I think that will be reflected in generous commentary from the credit rating agencies, and that in turn will be reflected in lower bond yields, both government and corporate. So that should mean the cost of borrowing is lower, and that in turn is a positive thing for the economy. So I can't really find much to complain about.
Right. Mark, good morning. Niraj here. And from my end too, thanks for joining in.
Thank you.
Two quick follow-ups, Mark. Somebody yesterday characterized this budget as a bond budget, saying that in some sense with India's inclusion in the upcoming JPM bond index, as well as mentions of that Bloomberg index, and the fact that India's kind of made a pitch to the rating agencies that we are sticking to our guns, or in fact improving upon what we've said. So come and take notice and make some changes. In some sense, do you think it was a bond budget and meant to play to that gallery and show to that gallery that, hey, we are here to do business?
I wish I could find something to disagree with you on, but no, I can't. And I agree with everything that you've said. I think it is very much a budget which, just to repeat myself, is going to result in a better view from the credit rating agencies and from bond investors. And it also, in my mind, shows the confidence the government must have in the upcoming election, that they're not throwing a lot of money around. And that's also a good thing because they don't really need to, even from an equity investor's perspective, with an economy growing at about 7%. There isn't the necessity of really putting the pedal to the metal with fiscal stimulus. So it is a bond-friendly budget, but I think in a strange way, it's also an equity-friendly budget because it shows the confidence the government has that they will be here for a few more years to come.
Yes. Mark, the other aspect is the last 2 or 3 times, I didn't get to talk to you in the last 3 months, but all through the last year, you were constructive on Indian markets, but at the same time, maybe being more constructive on some of the other EM/Asia as well from time to time. I would love to understand, post this budget, what's your stance on India in absolute terms and relative to some of the other markets that you allocate money to or you get your clients to allocate money to?
Within the emerging market space, there are not many large markets. Of course, China is a large market. You have India as well. You have Russia. You have Brazil. Now, Taiwan and Korea are technically emerging markets, but I don't think anybody really looks at them that way anymore. They're developed economies. So within the big ones, nobody's going to be going near Russia, obviously. Brazil is very much hooked on the Chinese engine, and China, as you know, is going to be very slow. I think probably growth of about 4% this year, much less than India. So India has growth. It's also expensive. The two things I would say are, in my own career, with the exception of the very bottom of the global financial crisis, it always traded at a premium to its peers, and deservedly so, because of the things we all know about India in terms of the demographic profile, the large potential market, more recently the reforms which have allowed for investment in infrastructure, etc. So it is very expensive indeed relative to China, because China's down 50% from its peak of about 5 years ago. But the analogy I would use is, if I may, wrist watches. And if you could choose between one Patek Philippe Nautilus watch, if I could offer to give you one of those, which cost, I think, about $3,000. Sorry, much more. I know more. It's about $150,000. Yeah,
much more.
And or a whole bunch of swatches. So I think an average swatch is about $300. So you could have one Patek Philippe, or you could have several hundred swatches. Well, I don't know. You tell me what you'd do, but I think most people will go for the one very expensive watch, because they know over time that will appreciate in value compared to a few hundred plastic watches. And I think India is kind of like that. It's expensive, but it's expensive for a good reason, because it really has so much in front of it that's good. You just cannot really say the same thing about many other places in the world.
Mark, you have a large following in India, but I must tell you, with this comment, you just increased that.
No, I wanted to paraphrase. Mark, are you saying India is the Rolex of
No, he said Patek Philippe.
Patek Philippe. We're the Patek Philippe of investments. Excellent.
At least in the EM space. But Mark, okay, so therefore, in some sense, you believe that an expensive market like India could remain expensive, and save for some global accidents, could continue to attract flows despite the valuations. Am I understanding you correctly?
Oh, well, the foreign flows are fickle. And so, for example, in January, there was about $3 billion, I think, of outflow from India. Yes. They come and go. I can't say whether there will be foreign inflows into India this year or not, but I also don't think it's really that important anymore. 20 years ago it was. And we saw that in 2008, of course, when the Indian market fell, lost half its value in that year. There was nothing the matter with the economy. It grew by 5% in 2008, but foreign investors were the ones who really determined the direction of the stock market. And of course, they were all de-risking their portfolios because of the financial crisis. So 2022, the S&P also had a bear market, and India was essentially flat that year, despite a lot of foreign selling. And the difference between the two episodes was that we now have, or you now have, a large domestic institutional investor base, in part through the systemic investment plan. And I think that will continue as the middle class grows and per capita GDP grows. So foreign investors, I really can't say what they'll do. It's pretty hot money, to be honest. But the local domestic investor, I think there's going to be a lot more of that going into the equity market.
Yeah. Mark, everything is looking positive from the point of view of what India is doing internally. Right, we're keeping the fiscal deficit tight, Capex is decent, etc. But global factors are adding uncertainty right now. You have a crisis in the Middle East. We don't know where that will go. How concerning is that for you? I want to get your perspective on it. And a take as well on the last Fed meet. The realization now that okay, there's not going to be a rate cut in March, but that's not necessarily something to fret about.
I would only say that in an election year, the last thing the incumbent wants in the White House is oil at $100 a barrel. And I think they will do everything they can to avoid a larger war in the Middle East. Somebody's obviously trying to start one. But so far, both the United States and Iran, I think, have behaved pretty cautiously compared to what could have happened. And I don't really think either side wants to go to war. I don't think there will be a larger war there. Not that I'm an expert in it, but just if I was Joe Biden, I would not want one at this point in time in particular. And then if you look at the betting websites and the polls, it's looking like we're going to get a second Trump administration. And I suspect he would be, there would be less volatility geopolitically. He is a very bellicose character, of course. But if you just look at his first administration, it was marked, in fact, by peace. He likes making deals. He's more interested in economies than geopolitics. Your other question, I can't remember, I'm sorry.
The question was on Jerome Powell, but I'm sorry, Mark, I've gotten completely distracted with your Trump comment, and I have to come to you for a follow-up on that. Are you saying that you think Trump 2.0 administration will be better for the U.S., by extension for global trade, than the current administration? Are you now accepting or digesting the possibility of a Trump 2.0?
Oh, the answer to both questions is yes. I mean, as I said, things can change. If he is in jail, he probably won't win because surveys show that many people would not vote for a candidate if they're actually in jail, understandably. But if he's not in jail, then I think he will win because the voting, the surveys and the betting websites show him with a very strong lead over Biden. And the other thing that could happen is that Biden steps down as the candidate for the Democrats, but they're getting very, very close to the wire. They've got to make that decision soon, and there's no sign that they will. So the two together, the polls and the betting websites give Trump an enormous lead. That's, I think, largely due to the inflation, which has made life very difficult, particularly for young and poor people. And so then I think it would be a positive. His first term, the market went up, if memory serves me right, 65% from the day he took office to the day the pandemic hit. He is, as I said, pro-business, pro-economy, pro-markets, and I don't see why it would be different in the second term.
The last question, and the one is about the Fed. Expectations of a cut not happening in March is seeming more acceptable to the market. Just your take on how much hinges on when these cuts happen and how steadily the Fed continues to cut.
I don't think it's very important, the timing of it. The most important thing is that they've given us very strong signals that there will be cuts. So we never had March penciled in ourselves. We're looking for a first cut in May, and then in then in July and September, and then January and June of next year. So, you know, barring a significant downturn in the economy, I don't think that there will be a very sharp series of rate cuts. It'll be steady, like the kind I described to you. And so far, there's no real signal that we are getting any big downturn in the economy. As you know, it's strong. So I think the market can live with that kind of trajectory that I just described to you and still achieve around a 10% return this year.
Okay. Well, Mark Matthews, you may be in a slight disbelief about your following in India, but don't be under any misimpression that you don't have people in the studio who like you. We love having you, and today was no different.
Thank you very much.
The pleasure was ours. Thanks for tuning in today. Well, that's Mark Matthews, Bank Julius Baer, and for the longest time that if you've heard Mark's commentary, he's spot on when it comes to his India analysis, and which is why it becomes such an important voice to have post-budget from an FI perspective.
I love that quote. We're the expensive watch that's worth buying versus a lot of cheap watches. So that's really the take of the day. A very quick break, though. We're coming back with a lot more analysis, a lot more stocks to watch, and all of the action you expect post the budget announcement. Stay tuned.
Back with India Market Open right here on NDTV Profit. Quick look at the headlines at the top of the hour. Dow resumes record run as Amazon and Meta post strong results. GIFT Nifty, on the other hand, is hinting at a positive start to trade. No rating upgrade for India for now, but growth outlook is strong, says Moody's in an exclusive interview. Adani Enterprises profit more than doubles on higher operating profit margins, expands 35 basis points to over 11%. Results came in yesterday during market hours. Paytm response to RBI action, says it will not disburse any loans. The stock ends the day 20% lower yesterday, wiping out almost 9,700 crores in market cap. And Baiju's major investors call for Baiju Ravindran and family ouster from the board. Well, the implied open should come up on your screen. Just trying to see how we'll start off after a day which kind of did what it was probably anticipated, which is a flattish close. But we'll have a strong start very likely today, independent of whether it's 157 points or 100 points or what have you. But we'll have a start which is likely going to be strong. The question is what will lead that charge, and I think we'll get to know that. But amidst all this conversation about the optimism, it's always good to hear a skeptic voice as well. We asked Jahangir Aziz whether India can become a developed nation by 2047, and is India's 6.5% GDP growth enough? He spoke about what he thinks of India's growth story. Listen in.
I stop myself from talking about things that are probably, beyond even my lifetime. So what happens in 2047 is so far away that, it's very hard to, even think about that. But then, political leaders have to have vision. And I think that it is an aspirational goal. And I think that if we even manage to get half of it done, it would be a significant achievement. Now, all of this boils down to what you consider to be a developed country, right? I mean, one of the criteria that we normally use is per capita income. I know there's a lot of focus on just in the size of GDP in India and in the market because, the size of GDP matters for markets. It's the size of the market that you're creating. But ultimately, development means that what happens to your per capita income. Now, if you think about per capita income reaching developed market standards, right? So you're, around what, $2,500 per capita income, right? To reach $60,000, $70,000 per capita income, you need remarkable growth rates. And that's a very tall order.
And 6.5% is not going to cut it.
And 6.5% does not get you $2,500 per capita to be $65,000 per capita. I think that's always been a problem when we talk about these kinds of comparisons. I remember, people were talking about, if you go back 200, 300 years, India was the largest or the second largest country in the world, pre-British time, etc. All of that is true in the size of GDP. India's GDP was large, China's GDP was large because India's population was large. And China's population was large. If you look at per capita income, the country that has significantly been on the higher end are much, much smaller advanced countries, such as Italy. We don't talk much about Italy these days. So I think we need to get a sense of perspective on all of this. Yes, GDP can grow, but can per capita income take us to the $65,000 mark? Again, within a generation, that too. That's a very tall.
And meanwhile, a lot of views coming in on the budget and the India story. The government is putting in efforts to uplift people below the poverty line, says Madhusudan Kela. He had a conversation with Niraj on the budget outlook, and we're going to play out, that entire conversation later today. But listen in to an excerpt of that chat.
The direction is very clear, even for the lowest credit of the society, the way this Pradhan Mantri Awas, that is getting built, they are very clear that they have to uplift a lot of people from the poverty. People who are being uplifted from the poverty, they have to go to middle class. The middle class has to go to higher class. I think housing is a very big need. It's being a very latent need. And atmosphere is just fantastic, Niraj, to do all of this. Government has so much animation right now, right? Because if you see when they inherited, at that time, there was some food subsidy with FCI, there was some oil bonds with BPCL, IOC. It is all being cleaned up. And in a clean manner, we are talking of 4.5% fiscal deficit. And I want to tell you one thing. Government of India has become very rich. People are not realizing that India is a country. We have a fabulous balance sheet. We may have a poor P&L, but we have a fabulous balance sheet. 13 lakh crore rupees was the value of all PSU companies put together 3.5 years back. Today it is 51 lakh crores.
Got it.
So government value has increased by more than 25 lakh crores in last 3.5 years. What ammunition does it give them?
Yes.
You divest, if 50 lakh crore is the market cap, you divest even 1 or 2%, you can raise 50,000, 1 lakh crore rupees. It can just change all the numbers on the fiscal side. And none of it is being taken.
Yes.
And if there is a really fabulous majority government, what stops them from selling 1 or 2 or 3 companies on a strategic basis and really get these divestment numbers really kicking in and take that money and invest into housing, invest into uplifting people?
So why is that not happening? Why do you think on the divestment side?
I don't think it was right to take that assumptions today, because again it was an interim budget.
No, but even the divestment targets for FY24, we are far away from...
Maybe, I don't know, maybe it is by design, because they have understood that there is far much value in all these public sector companies. So why just sell them for a song?
Got it. Okay.
Right, and now you see yourself, today if you want to sell 10% of Hindustan Aromatic, you can get 20,000 crores.
That's true. That's true. You've been very constructive on PSU banks, yes, but PSUs as well.
PSU as a whole.
You continue to remain constructive.
Absolutely.
Okay.
Absolutely.
The other aspect is this whole rally in the Capex.
However, I must warn you that railway stocks, to my opinion, I'm not comfortable with particular few stocks valuation in the railway segment. So I think either they pause or they decline. I don't know what happened, or they passed some time. But there the valuations are stretched, according to me.
Important comment from Madhusudan Kela on railway stock valuations running up. Keep an eye on them today. That entire conversation at 12:30 this afternoon on NDTV Profit. Don't forget to tune in. But we've been speaking to a variety of voices post the budget, and the interim budget has brought fiscal discipline back in focus, setting the agenda for India to become a developed economy. For all the records set by India in terms of growth, fiscal management and banking stability, global rating agencies are still not prepared to upgrade the rating for India. My colleague Muralidhar Swaminathan spoke to Christian D. Guzman, Senior Vice President, Sovereign Risk Group at Moody's Investor Services. Listen in.
How do you view India's growth? We are the fastest growing. I think recently IMF also upgraded the growth by about 40 basis points, if I'm not wrong. How do you view India's growth outlook from here?
I think that's correct. We do agree with the IMF's assessment. When we compare India to other economies, I think it's more appropriate to compare them with the large economies, those in the G20. And from that perspective, India is going to be the fastest major G20 economy, fastest growing major G20 economy in 2024. And in fact, according to our projections, in 2025 as well. And that is going to outperform China, which is undergoing some structural and cyclical issues of their own. It's going to outpace the U.S., which is the largest economy. I'm pointing out these two because, from a sovereign ratings perspective, it may be useful for your viewers to note that we have negative outlooks on both the U.S. and China.
Okay, so it's heartening to know that you have a positive outlook on India. One last question, Christian, before I thank you. Doesn't Moody's consider changing the criteria? Because, Philippines is a completely different kind of an economy, or for that matter, Indonesia or anybody else. Today, India is kind of as the Prime Minister had said, at the cusp of takeoff. Would Moody's consider revising their criteria in a manner to give more weightage to growth and less weightage to managing debt?
The answer to that is we are a regulated entity. And according to those regulations, we are regulated by a number of regulatory authorities around the world, those in Europe, those in the US, those in Japan, Singapore, Hong Kong, in the various jurisdictions. And part of that regulatory setup is that we are obligated to review our methodological approach every few years. And so that discussion does take place on an ongoing basis. We do review some of the lessons learned, so to speak, in the interim, and see how credit quality is actually being determined by some of those factors that we are looking at. So, we're not going to be tailoring our methodology to what's happening in India, but we will, tailor our methodology or adjust our methodology to reflect, some of the things perhaps we may not have looked at. For example,
sorry, we need to move. It's 8:43, time to move to specifics and start off with the biggest newsmaker in trade yesterday, which is Paytm. In a press conference after RBI's crackdown, Vijay Shekhar Sharma discussed RBI's action and its impact on the business. Listen in.
The important thing is that Paytm Payments Bank has received regulatory directive from RBI, and we are taking immediate steps to comply with the directions. The users of the Paytm Payment Bank can use the saving account balance, the wallet balance, which is used in FASTag and NCNCA, etc., account till 29th February. And effectively, that means that they can continue to add money, etc. But after 29th February, they cannot add incremental money to the bank account or saving account and so on. OCL as a payment aggregator for online offline merchant, and already works with various other banks, and Paytm Payment Bank is one of the key banks in that. And from here on, we are very clear that we will work with only other banks and not PPVL. And PPVL is just one of the various other banks, any which ways. OCL has already been working with other banks since last 2 years, and especially when embargo had come to the payment bank, we already had started to work and accelerated the plan for movement to other banks, and other banks have actually already started working with us. So it is an important thing for me to tell you that we continue to decline and decrease the slantwise dependency on Paytm Payment Bank, but there is a still significant enough dependency, I would rather say, there. And we now accelerate the plan and completely move to other payment banks partners. And remember, these are payments related relationships, which means all banks have necessary technology and capability already there. And I'm very happy to tell you that we are genuinely overwhelmed by the support that we've received from the various banks, large banks of this country and our country, and those who are already a partner, and more additional large banks have reached out at very, very senior level to say that they will be very happy to help us and happy to execute relationships that we in past have been doing with Paytm Payment Bank. And we obviously very clearly, we are going to take that as a step forward and work with current and many more incremental bank partners. Going forward, the keyword is that we will not work with Paytm Payment Bank, and that is what probably means that other banks will come. With regard to the direction on termination on nodal account of OCL, that is 197 Communication PPSL by Feb 29, OCL and PPSL are already in process of moving nodal account to other large commercial banks, and that will be done definitely before the due date. And OCL's marketing and financial services businesses, where we market and sell other services to the consumers, are not affected due to these directions. And these directions are towards the associate company, Paytm Payment Bank Limited.
So that was Vijay Shekhar Sharma trying to calm nerves after RBI's crackdown. They are going to move their volumes out of Paytm Payments Bank. Is that enough to calm fears? Harsh is joining us with, of course, the key bullet points from that con call, as well as this question, Harsh. Has he said enough to assuage fears?
Oh, well, that's a great question, Tamanna. I'm going to first, as you said, try and summarize the call in a few points. One, my key takeaways. One, they will not work with Paytm Payments Bank anymore. They will have to hunt for other banking partners. They already have banking partners, but they are looking for others as well. 1 to 2 others is what was mentioned, and probably one large bank, if not 2 banks. That's point number 1. They'll stop the loan distribution business temporarily. Now, that may also have a temporary hit with regard to their profitability, especially in Q4. So that's one thing we'll have to look out for. Where it comes to what kinds of businesses they can do, we've discussed that in a wide variety. They can do all other businesses other than payments in-house. They can do payments with other banks which they are already working with. Now, what they are also suggesting is RBI and NPCI both are helping with the account migration to other banks, and they will have more clarity on how they will migrate the customers, because that will be key. The process, the procedure will be the key. And, that they are suggesting they will have more clarity on only next week. With regard to retention of customers, they are confident that they will retain customers and merchants on the platform. Now, let me also try and flag off certain big questions that remain unanswered. One is the 300 to 500 crore EBITDA impact. Is that permanent? Annual, but is that permanent? Because the 9-month FY24 EBITDA number before ESOP is at 460 crore. ESOPs of around 1100 crore have been issued in 9 months. So if you look at the EBITDA impact, it's quite chunky in the current year, while by FY26 that may be 30% as per Citi's estimates. But it's quite chunky. Is that a permanent impact or not? Remains unanswered. What does this do to profitability, as well as where the profitable in terms of the timelines profitability is concerned? Where do we stand? When does Paytm now finally turn profitable? What will larger impact on customers be? They've said there is no impact, but there is a big question mark on that. How will they retain customers? And what has caused these restrictions? The management currently seems to be quite in the unknown as to what has caused these restrictions. They still believe that it's certain unforeseen things which they do not or they had not really expected and anticipated. And what happens when the restrictions on Paytm Payments Bank is lifted? Do they migrate the customers back to Paytm Payments Bank? Mind you, they have 30 crore plus customers.
Yeah, absolutely. So a lot in store for Paytm. Will there be some kind of movement? Remember that stock was stuck on a 20% lower circuit through the day yesterday.
Yes, there will be some kind of movement, and the movement will be lower.
The moment it opens back lower, you think?
I don't know about opens circuit down or no, but very likely that this will still be lower.
You know, what I found interesting in all of the commentary Vijay Shekhar Sharma made yesterday as well, Niraj, was how it was a call for support. He's trying to make this a story about the fintech space and the startup space and try and deflect from any sort of trying to say this is not a Paytm problem, this is a bigger problem. But let's see if that really gets digested by the market.
Yeah, very unlikely, I must add. But, okay, speaking of the market, let's get in some views about what to do on a day like this. Kush Bora, founder of kushbora.com, with us on the show. Kush, great having you. Thanks for taking the time out. Good morning to you. How are you approaching Indian markets today with the presumption that they start off slightly higher by virtue of what the global cues are suggesting? What's the trade post that?
Hi, Niraj. First up, a very good morning to you and to all the viewers, and always a pleasure to be here.
Thank you.
Let me just put out two numbers: 20,200, rather 22,200 and 22,500. These are the next stops that we're looking at for the Nifty. Now, the budget was, broadly speaking, budget didn't do any harm to the investor sentiment, right? And it was business as usual, and business as usual will resume. In fact, to the extent that the yesterday's move on Nifty was more expiry driven, the weekly options expiry driven, than the budget specific move. So that's actually a very good thing. The supports were anyway shifting higher from 21,300 to 21,500, and now perhaps even 21,600. So 21,850 remains a bit of a resistance, but once that is taken out, we do see Nifty moving to 22,200 and 22,500 levels. That's the positional view that we have, at our end from the Nifty perspective. However, just for today, being a Friday, there's a possibility that we could see a gap up opening. Then the indices might perhaps cool off a little. So I wouldn't say go out chasing the gap up. Once we cool off, is perhaps a good time to enter and take a positional bet on the index. 22,200 is just on the corner.
Yeah. Kush, very good morning. Tamanna here. I'm interested with the Friday comment. Why do you think that makes a difference? And what about some of the names on the bank Nifty and public sector banks? They had a great run yesterday. If everyone else or other stocks and sectors were non-reactive per se to the budget, PSBs definitely were not. Any picks over here?
Hi, Tamanna. Very good morning to you too. Well, a couple of reasons why the Friday effect plays out. Once it's a more psychological thing, right? You don't want to take, a big position just ahead of the weekend, given the kind of global uncertainty we are in. You never know what happens in what corner of the world and, how the positions go. That's the generally accepted, theory. And, we've seen that also play out. Also, from an options expiry perspective, you could sell some call options here and there. And, if you look at the data right now, 21,800 and 22,000 are the strikes that have a very strong call base. So perhaps, if you open close to 21,800, 850 kind of levels on the spot, then there is a possibility that, the sellers might want to hold on to this position, see the Nifty, stay in that range so that the, thetas can perhaps come in their favor. So from that perspective, also the Friday effect might kick in. And also you're spot on when you, mentioned about the PSU theme. In fact, if you see the bank Nifty is primarily jumped up only because of the PSU names. Thanks to HDFC Bank, which has now arrested its fall. But other than that, the bulk of the heavy lifting has done by the PSU names. So we are still bullish on Canara Bank and SBI among the big names. And incidentally, my picks today, are from the, at least in the banking space, is from the PSU space.
Amnish Agarwal, Head of Research at Prabhudas Leeladhar, with us on the show as well. Amnish, great having you. Thanks for taking the time out. I want to start off with something that is the talk of market circles by and large, which is what can happen to PSUs, PSU financials in light of the fact that with the fiscal deficit number the way it is and the borrowing number the way it is, can talks of a rating upgrade up the, how do I say, propensity to bet on PSU banks? Is that something that is possible?
You see, PSU banks have seen significant re-rating in the last 6 to 12 months. So their own balance sheets were in good shape. And if you go by the numbers in the budget yesterday, where the fiscal deficit is under control, and then government is looking at much less borrowings next year. So I think that is a very good news for the entire financial sector, because then their ability to garner deposits, push growth, that increases. So if that happens the way it looks, and PSUs are able to say sustain growth and the balance sheet quality, then there is scope for further re-rating of many of these stocks, particularly the frontline ones.
Okay, pertinent point. We need to slip into a break. We come back and try and get the Prabhudas the other view on what stood out from a budget beneficiaries with Amnish. Get in some stock recommendations from Kush. We missed out on that. We do all of this after this very quick break. Stay tuned.
All right, about 2.5 minutes left for pre-open. It's looking like it's set for a good day, but we'll have to wait and see if the kind of positive cues we've seen overnight, very positive cues on Wall Street, all of Asia, actually look like they will reflect in the Indian markets as well. Kush Bora and Amnish Agarwal with us this morning. Amnish, take from you on whether there's going to be a delayed sort of reflection and reaction to what the budget actually means. For rate sensitives, for example, we already talked about public sector banks, but real estate and the lot for NBFCs. Does the fact that the government is reducing its borrowing, sticking to its fiscal deficit target, at the end of the day mean a bit of easing of pressure in terms of cost of funds? Will you see positive reactions over here?
You see, there are two things. First of all, it's an interim budget. Okay. The second one being that these numbers, I think, except the number on the fiscal deficit and the borrowing, I think most of the others were on the expected lines. I would say the fiscal situation looks good. Now, if you want to say translate into bigger picture, yes, whether it is NBFCs or some of the other sectors, for them the outlook definitely looks positive from the view of cost of funds. But if I look at, say, a very broader canvas, then I think it is directing towards more like making India a developed country. So I think still, if you go by the finer numbers, a lot of emphasis seems to be there on capital goods, infrastructure development, railways, engineering, new technology, green energy, all those I would say areas. But I think it is much beyond just the financial numbers. I think it is basically the continuity of the policies which the government was following, particularly in the post-COVID scenario.
All right. Just a quick follow-up there, Amnish, on your take on rail stocks. And we played out a clip of Madhusudan Kela a little earlier saying that, yes, Capex is there, push is there, you're going to go railway 2.0, all of that. But the way rail stocks have run up is making him uncomfortable at this point. Your take over there, and what would you be positive on right now post the budget announcements?
You see, as far as the railway stocks are concerned, I think some of these stocks have definitely rallied very sharply. For example, yesterday, I think BML, which is now a play on railways also, it was also by, I think, some 7, 8 or 10% range. So all the railway stocks have gone up massively. There is absolutely no doubt whether these are railway EPC companies, whether these are wagon companies or the companies which provide other equipment. So I think at this juncture, yes, if you look at incremental increase in allocation is not much, but they are sustaining the momentum of, you can say, growth. So I think whether these are railways or some of the other segment, I think incrementally one should be looking more at where there is more visibility, there is some sort of a technology edge which is there in terms of companies, and where you can say one can see the longevity of earnings and growth. Because when any sector has run up so massively, I think it is very important to distinguish between the companies where the balance sheets are very strong, where the companies need to have any USP to continue rising. And I think then if you ask me, if I have to say, stick my neck out and pick a stock which is a play on railways, although it's not direct, I think I will go with Siemens. Because they have got a huge locomotive order. They have also, I think, one of the companies supplying Kavach. And it's a large cap stock with the possibility of energy segment demerger over the next 12 to 18 months. I think there's a lot of scope in this large cap to add value and unlock shareholder value from demerger.
Amnish has been bullish on this one now for the last 2 times that we've heard him. So keep an eye out on this for sure. And yeah, the Capex argument is well taken actually. The effective Capex is maybe 16%. And if you take in 11 months of operations in the year because of Achar Sahita due to elections, then the actual number for 11 months is actually even higher. So keep that at the back of mind, viewers. But pre-open rates have started and we'll of course, revisit these when they settle down. Kush, come to you because we still haven't been able to take your calls. What is it that you're recommending within this market construct that you have in mind?
A couple of them. One is from the cash segment and the others from the F&O. Beginning with the cash segment pick, Union Bank is something that I have on my radar, not often discussed, given the likes of PNB and Canara Bank take the center stage. Union Bank has been doing rather well, positioned very well after, a brief phase of consolidation. I think 148, 152 are fairly reasonable targets on this one. 141 is where I would place my stop loss. Ambuja Cements is my second pick. The stock has been, on an up move with a fair degree of consolidation, which is a very healthy sign. I mean, rather than a tear away rally, you'd want a bit of consolidation. In a bit of a downturn for the last couple of days, but I think that was in anticipation of the budget. Now, once that is out of the picture, I think 580, 595 are the targets we're looking at in the near term. And 555 is where I would place my stop loss. And just as a standard disclaimer, these are some of the calls that we've discussed with our clients as a part of our advisory service also.
Kush, quick view from you on the rail stocks. Texmaco, Jupiter had good numbers out. We'll pull up what they're doing pre-market as well, or pre-open as well. But anything here that you think is still worth picking up despite all the commentary on run-up, and both are doing fantastic, at least pre-open?
Incidentally, I was listening to your comment and the segment that you played about Madhu Kela also making a comment on that. Fairly well taken in the sense that rather fundamentally these could have been an overshot play already. But what's interesting from a technical perspective is that these were due a rally. Almost all of them were due due a round of profit booking, and it came, but it was just one day of sharp profit booking, and then all of them have come to the level that they fell from. So from a technical standpoint, they aren't really on such a bad footing. From my perspective, IRFC is one stock that we've recommended yesterday. TechRail continues to be one of our top picks. RVNL, IRCON, these are some of the names. But if I were to just pick two of them, then we've got IRFC and TechRail that I've got on my radar. Any dips on these would be considered as a buying opportunity. As I said, technically, there was a dip due that's come in and been bought into. So from that perspective, they're still on a very strong footing.
Okay. So, well, strong footing for now, looking okay. Let's see if there's profit booking there. Amnish, come in on this one. A lot of times stocks rise a lot and people get skeptical. I'm trying to wonder, while you're constructing this Capex thing by and large, does railways become an avoid currently because of the valuations, or does earnings growth make up for it?
See, usually it always happens when a sector is in fancy that when it goes up, you will always overshoot the fair value at times. And when any sector is down in the dumps, it will be dirt cheap. So I think I don't rule out that in the near term, some of these sectors or some of these stocks are factoring in all kinds of possible positives. Okay, and that is why there is no room for error over there. But having said that, and that is why I said that if you want to enter into some of these names, one has to be very clear about what is buying into, and one should be ready that if there is a correction of say 5, 10, 15%, so that can come in this counter at any point of time.
Absolutely. Thank you for that, Amnish. Great speaking with you this morning. And, a quick look at pre-open as well in terms of how we are panning out and what the markets are looking like. And in not very positive territory, but definitely up in the green. We'll wait for that to settle as well. Kush, I just want to get your take on a couple of counters which seem to have some movement based on results, etc. Indian Hotels is one of them. Is looking positive pre-open. Bata is the other one looking negative pre-open. Any take on these?
So Indian Hotels has been, on our radar, although it's not our top pick at the moment. We've got the likes of Sami Hotel as, that we've mentioned as a pick. In a bit of a consolidatory phase over the last couple of days, volumes have been waning off. So I think 500 is a resistance on Indian Hotels and, might continue to play out for some time. Although if anyone's got a position on it, no point, selling out too early. 485, 480 is a good support zone. So place your stop losses, around those levels. Bata, well, I think, no surprises there. The stock actually not done anything in the past, I think, quarter or two, continues to languish. And, the last leg of sell-off has also seen a jump up in volume, which is not a healthy sign at all. So I think Bata is a very clear avoid. Perhaps 1300, 1350 are the levels that we're looking at. If it does sort of arrest, its fall there, then we may consider, but nothing at the moment. Bata is a very clear avoid.
Okay. Rahul Arora, CEO at Nirmal Bang Institutional Equity, is also with us. Rahul, good having you. Thanks for joining in. We'll take in the budget view, Rahul, in just moments from now. But because it's just 6 minutes left to open, I'd have to start with the specifics. We'll get to the macro in a bit. I would love to understand what you think about some of the consumption names as they've come out, because you were amongst the first ones to raise the flag on the valuations of some of the food companies, and God knows the numbers haven't been that great. Bata has come out and disappointed. Some others have also looked a bit lackadaisical. What is your overarching view out there?
Good morning, Niraj, and thank you for having me on the show. So I think, Niraj, there are different pockets of consumptions, right? And I think the one that you're referring to on valuations is obviously the consumer staples, which is, you're still paying very high multiples for very low growth. And I think, Niraj, for the benefit of your viewers, just for them to understand, Hindustan Lever went from 300 rupees a decade back to about 3,000 rupees. It was a move that came in broadly between 2011-12 and about 2020-2021. In that period, if you see, Hindustan Lever actually compounded its top line only by about 8.5%. Now, 8.5% was a mixture of volume growth, pricing, and premiumization. So you can just imagine over a decade, if you're looking at an 8.5% compounded top line, the volume growth would have actually been in low single digits, sub 5% over a 10-year period, right, across cycles. But the reason Lever became that 10-bagger was that the margins of the company, which were operating at 13-14%, went to about 25%. So you had EBITDA and earnings compound for over a decade at about 16-17%. Now, unfortunately, what's happening for consumption stocks now, Niraj, especially consumer staples, is can we sit here and say these 25% margins will become 35%? I don't think anyone's taking that call. And on top of that, if the volume growth is going to remain somewhat similar to what it was in the last decade, these valuations will be very challenging to hold. They may well hold in terms of the absolute number, Niraj, but these may not significantly rise as investments. I mean, if you look at Hindustan Lever today, it'll find it very difficult. I mean, even if you plot a graph, it's not beating your GSEC yield in terms of returns. I mean, if I can get 7.5% in a GSEC yield, or if I'm a senior citizen and I can get an 8% in a fixed deposit, I at least want a 12, 13, 14% return in the stock that I buy on a compounded basis. So I don't think consumer staples is going to do that for you. Consumer discretionary, on the other hand, still might. Because if you look at alcohol, Niraj, and specifically even tobacco, since the introduction of GST, there's not been too much movement on excise, right? I think GST collections have been good. So the government hasn't tinkered too much with tobacco and alcohol excise. So I think United Spirits and United Breweries may still continue to do well. Within this, I think because we're getting into a summer season and we're getting into an IPL and a World Cup T20 after that, I think beer may outperform spirits. So United Breweries may continue to do well. But some of the other consumer discretionary pockets, whether it's QSRs, hotels, there the valuations have started to look very absurd to me, Niraj. So I think the only place where I'll probably look to buy consumption right now would probably be Alcobev. Within that, maybe something like a United Breweries and something like a Gillette or a P&G, which are continuing to show me good margin improvement. So these would be maybe 3 or 4 names that I would look at. The rest of them at best would be a hold rating, or I think you can probably avoid most of the other names on the consumer staples or discretionary at this point.
Amongst the best answers and the best thoughts that you will get on consumption space, Rahul Arora, people, and just trust me here that his calls on some of the consumer names as a brokerage house, Nirmal Bang, has been spot on, so worth listening to.
Yeah. Talking about discretionary spends, at least, Mahima is joining us with a list of earnings numbers and the reactions that we could see. She's talking about IHCL and Bata this morning. Yes, Mahima.
Right, Tamanna. So IHCL has recorded an all-time high consolidated Q3 number EBITDA with an EBITDA margin of 38.5%. 28 hotels were signed and 16 hotels were opened in this fiscal year. The robust performance is on account of same-store hotels clocking revenue per available room premium across market segments, and they've successfully launched the Ginger Mumbai Airport Hotel, where they clocked an occupancy rate at 80%. Also, the new business verticals have been growing at a significant growth rate of 33%. If we talk about Bata numbers have not been very good. They've missed analyst estimates. The net profits have declined 30% year on year. However, sequentially also, if you see, the EBITDA margins have significantly declined. Now, despite of the gross margin improvement, we've seen that the EBITDA margins have declined to over 20%. The margins are impacted due to significant investments that they've made in brand and technology strategies. So these will be the 2 stocks that will be on the radar today.
Absolutely. Some of the stocks on the radar, and just about 2 minutes left for market open. Rahul, quick take from you really on, what would be your big play today? Would you look at the banking space more closely even after the PSB run-up yesterday?
So I think, Tamanna, when you're looking at building a portfolio right now, I think in the context of so there are 2 things. Either you look at companies that are increasing their cash flows or showing you significant returns on capital employed. And I think for me, where both these things marry is cement. And I think that's probably, it'll probably tie into what the government is trying to do on infrastructure as well. And I think if you look at the numbers of some of these stocks like Shree Cements or JK Cement, and I think for a lot of other companies that will subsequently come as well, I think the high cost inventory has been replenished by and large. So I think you're going to see a huge improvement in EBITDA per metric ton in a lot of cement companies. So I think that's probably one pocket. And, Tamanna, I think one of life's greatest mysteries is the valuations of public sector banks. I mean, if you look at Bank of Baroda, it's a 16% ROE bank. If you look at State Bank of India, it's an 18% ROE bank. and the valuations are at what? At 1 time, 1.1, 1.2. It's less than half of its private sector peers. In fact, it's less than half of the worst private sector peers. And, a lot of these were corporate lenders back in the day, maybe about 8-10 years back. But today, if I ask you, can you name one corporate that's going to default in the next couple of years? We won't be able to name it. So the cycle has turned. A lot of these banks have retailized. And logically, intuitively, I'm not saying that PSBs need to get the same, valuations as PVBs, private banks. But why shouldn't an SBI or a BOB be 50% higher than where they are right now? So that's one of life's greatest mysteries, which I'm not able to resolve. But I hope that this corrects itself. But I think cement and public sector banks at this point in time would be probably two of the key big themes that we would like to play for the next one.
Yeah, there was another mystery, Rahul, which is getting HDFC Bank at the valuations that it is coming at, which is what you referred to. And by the way, Kush Bora spoke about Ambuja Cements and a PSU Bank in Union Bank. So there is a bit of a confluence out here. And we'll talk about those ideas post-open as well and ask Kush whether he would still trade them because they're probably going to start off higher. But this Friday morning, we'll have Paytm start off lower. We'll have the market start higher. Let's see what else is in store. So first up off the block, good start for the indices, 0.5% higher for the Sensex and the Nifty. The mid caps and the small caps. Nifty Bank, good we pulled that up. 0.8%. Love to see what HDFC Bank and PSU banks are doing more importantly. And bring up mid caps and small caps. Just see there, 0.5% higher for the mid caps. And the small cap index, is it doing much better than the others? Well, yes, it is about 1% higher for the small cap index too. So very strong market breadth on open, I presume. Let's get the heat map up and see the Nifty breadth for sure and see what's moving and what is not. So on the downside, there is only iShares, nothing else. On the upside, Adani Ports 3% has an upgrade today after its results. So 3% higher for Adani Ports. Titan up about 2%, and the commentary suggested an earnings upgrade for that one. ICICI Bank about 1%, SBI Life. There is a bit of tech flavor too, by the way. HCL Tech, Wipro, Infosys, and Tech Mahindra, all three or all four in the green. TCS2 in the green. So except for LTI, even LTIM. So Nifty IT and Nifty Bank both participating. So extremely strong breadth. Reliance is up about 1%. I don't see Adani Enterprises in the mix, but about 1% higher for that one too. But clearly the standout performer, you would have to argue, is Adani Ports by virtue of that brokerage upgrade that has come in for that one. 3.5% and clocking. And yes, I'll be amiss if I don't mention Hero Moto. Tamanna mentioned it in the trade setup as well. 2% on the back of the numbers that have come out for Hero. Maybe TVS is reacting too, but clearly this is a very, very strong start. Now building on viewers, by the way, 0.8%. So we actually built up from where we started off. So it's a strong start. Not so much for Paytm, I'm afraid. That stock will come up on your screen before I hand it over to Tamanna. Down about 20% yet again, 487, and this may not be the end of it. At the somewhere around close, we'll figure out what's the number of sellers like versus the total volumes done. Very likely that this will probably have another down day on Monday. Tamanna, what else is standing out?
Absolutely. Paytm, no reprieve at all. It's been flatlining since yesterday, and that continues. That's just pretty much about what red you're seeing on the screen. Markets opening with great enthusiasm this morning. Let's look at what's happening with your railway stocks that we've been talking about. So results flow, digesting the budget as well. I'm going to start off with Jupiter. Good numbers over there. Margins up 144 bips. EBITDA up 55%, and the Q3 PAT also looking solid. That stock up 5% this morning. Tex Maco is another one we should pull up and look at what's happening there. And again, 4.5% up. So a realization. So a couple of things over here. Realization of what the budget actually will mean, because when you look at that capex figure, yesterday you saw 11% bump up, but when you look at it compared to what the government spent last year, it's still 17% higher. So railway is hoping for the pace to continue. Bata is another one we'll talk about. Disappointing numbers, and on a day like today, even with a 30% drop on the PAT, you're not seeing too much of a sharp cut on Bata. So that's one to look at. Citi, by the way, has a sell call and a price target of 1340 on Bata. Rights is another one that I would pull up. The decent flattish numbers, actually not very good at all. Margins were down 377 pips. That stock down 2.5%. Gokul Das Exports is another one. There's a bit of news this morning. They've signed an agreement to buy Matrix Designs. Their numbers are also out, and that stock 3% up. So a whole variety of stocks going to react on an upswing, and we'll get into more detail on that. But Niraj, overall the mood very, very positive. Delayed reaction and understanding of what the budget means?
Tamanna, you called it out on the trade setup today, and in some sets it's played out that way. Let's wait and watch whether this builds on from where we left off. Just a very quick mention of something else that might be moving before we get to our guest very quickly. But such a strong start is great. NBCC is up another 11.5%. From Hudco, from where it left off, is up another 9%. Maybe Tamanna marked it, but watch out for that. Castrol is reacting to a strong set of numbers yet again. KPIT Tech, expensive as it may be, is up another 3%. There is strength in Z, so yet another stock which stands out. But PSU banks certainly seem to be a pocket of strength this morning. Now, Kush, I'd like to start off with you on two things. So one, your ideas, and Union Bank in particular, PSU banks have started off well. Is there a trade still there? Couple that up with a view on Adani Ports, because that stock has started off really, really strongly.
So, Niraj, first a quick word on the indices. Both Nifty and Bank Nifty were actually at the resistance zones. 21,850 on the Nifty and 46,500, which is the 50 DMA on the Bank Nifty. What's very interesting and heartening to see is that even if it's been just 5 minutes, to the market open, both the indices have opened above the resistance zones and are gaining strength. I think if we can hold on to these levels for another half an hour or so, I think there'll be a short covering rally kicking in, perhaps today itself. So a very interestingly poised Nifty and the Bank Nifty. Now, as far as the PSU banking play goes, still there is steam on Union Bank. 148 was our first target, which was achieved at opening. So not much trade there from the first target perspective, but 152 was the second one, and the viewers can still get on the bandwagon for the second target. I would now revise my stop loss to about 144, which was the closing yesterday. Even the rest of the PSU bank space has been doing well, will continue to do well, but Union Bank for the day at least remains our pick. Adani Ports, again, one pack which has been doing well, and I think will continue to do well running up to the elections, is the Adani pack. Adani Ports and Adani Power were anyway our two top picks from the space. I don't see a reason why there should be a bout of profit booking or any rush for profit booking. Hold on to this one with a trailing stop loss at 1225. If you want to enter into the stock from a fresh position perspective, that should act as your stop loss. And 1300 is perhaps the next level that we're looking at on Adani Ports, and higher if there's a positional bet.
Yeah. Absolutely. Thanks so much, Kush, for joining us this morning. Adani Ports in fine mood. Can't say the same for Paytm. Max Health also taking a bit of a knock after decent numbers and a positive brokerage report, but that stock 4% down. Remember, it had run up in the last couple of sessions as well. Ashok Leland also showing some signs of weakness, but on the positive side, you have HPCL, Abbott, Z Entertainment, Union Bank, all of them. Motherson Wiring also in the back of numbers doing well. Rahul, a take of what is directionally happening in the markets today. Are we reacting to what we've seen overnight, sort of understanding that the cut is coming, the Fed cut is coming? You just have to show some patience, and digesting the news that every budget need not have big bang statements. The fact that you're willing to tighten the purse strings when required is also a positive.
So I think two things, Tamanna. I think first off, we need to understand why what is happening, right? I think if you look at the mutual fund industry at large, and this is something I often make the point of when people ask me, why is there no significant correction in the market? You are sitting at almost 50 lakh crores of assets under management. Of that, I think 50% would be equity. So about 25 lakh crores would be equity. And if you analyze the fact sheets of most of the mutual funds on a monthly basis, you'll find that generally the average cash positions would be about 3%. So you're talking about 75,000 crores of cash lying idle with mutual funds to invest at any point in time. On top of that, you add insurance companies, you add the AIFs, PMSs, even LIC. My sense is you could easily double that number. It could be 1.25 to 1.5 lakh crores. Now, this number of the mutual fund industry used to be just about 5 lakh crores pre-demonetization. So in 7 or 8 years, the mutual fund industry has gone up 10x. Now, what happens, Tamanna, and I think this is very important for your viewers to understand, is that for most fund managers today, as per regulation, I think 20 or 30% of their CTCs are locked into the funds that they manage. So performance on a quarterly basis is extremely important. So when you have situations where good quality stocks fall 10-15%, the fund manager has no choice but for him or her to come and buy that name. So those days of stocks falling 40-50%, I think, are history. We are in a new normal. We need to align to that new normal. Obviously, there'll be one-off extraneous events like you have in the case of a Paytm or you had in the case of a Polycab a few days back. Those are different. But I'm saying purely on fundamentals, if you have one bad earnings like you're seeing in the case of Bata today, there's not going to be too much of price damage when you know the company is good, the management is good, but the business is going through just a slight tough phase in the interim. Every dip will be bought into. So that's one of the reasons why the correction is not coming. The second point, Tamanna, I think now everyone after the last state elections knows that this government is going to come back into office in a couple of months from now. And I think the finance minister, when she spoke yesterday, gave one very important line in her budget where she said, the next budget that I present in July will lay out the blueprint of what she calls Viksit Bharat or Developed India by 2047. Now, if you look at the last 10 years of this government, Tamanna, it's been a lot about regulation, you know, the demonetization, GST, IBC, RERA, NCLT, bankruptcy code. It's been a lot of foreign policy driven initiatives by the Prime Minister, particularly in the Middle East. There's been a pandemic management, and now you have the Ram Temple that's opened. So a lot of what the BJP promised in its manifesto over the last 10 years has been delivered. So the question is now when they come in the next 5 years, what will they do? My sense is the square focus now can only and only be the economy and the markets. They will want to divest more. So I think the next 5 years could potentially be the best 5, I think, and I hope I'm not wrong, and dare I say, but I think the next 5 years could be very similar to what you saw between 2003 and 8 in what a lot of people call the best bull market in India. And don't be surprised that the Nifty actually is sitting at 45 or 50,000 when you go into elections in 2029, because I think now the government has pretty much fulfilled everything it had to from an economic, socio standpoint. It is only the economy that's going to be at the center of it all. And, you know, like I said, when you couple that with liquidity, and as you rightly pointed out, this is going to be a year of rate cuts, I think all of it adds up to a very positive outlook. Near-term valuations may be challenging, but my request to your viewers would be, if you are buying one stock today, and this is actually taken off from, you know, the serial Scam 92, which came out on OTT recently, buy the stock called India. You will not lose money, even if you buy it from here and hold on for 5 years.
Oh, you know, Rahul, I have rarely heard you with such exuberance. You're not the one generally for so much dialogue, Bazi. So I'm going to take that very, very seriously. And that's where the end of it. Buy that one stock called India. You're seeing that in the PSU stocks this morning. NBCC 14% up, SJV and NTPC, Power Grid, all of them having a great morning. Thank you for that, Rahul. Great to have you on the show. Very quick break. We're coming back. The conversations continue. HSBC's Pranjul Bhandari is with us. We're going to be hearing from Titan on their numbers and a lot more on the other side. Stay tuned.
right, back with India Market Open on NDTV Profit. Titan reported a double-digit rise in its Q3 revenue. We spoke to the CFO Ashok Sonthalia regarding the company's FY27 guidance and the outlook on the non-jewelry segment. Listen in.
I think after FY22, first 2 years have been going pretty well. Actually, we are ahead of our required CAGR rate. And that gives us confidence that FY27 guidance is intact. And it is more, what we need to do, of course, we are doing. But I think India macro consumption story is also supporting this belief that we should be delivering FY27 2.5x of jewelry revenue.
Right. Ashok, sales in terms of eye care, ethnic wear and perfume, they have been facing challenges this time around. What's the trajectory looking like?
While opportunity is there, but of course, difficult market conditions. And if you look at even Q3, across industries, the behavior of consumer and behavior of segments are very, very different. While we saw jewelry and watches doing extremely well, eye care, fragrances, etc. faced a lot more competition, lot more subdued demand industry-wide. It's not that in eye care we fared what we did. What we believe most of the players have been kind of witnessing that kind of trajectory. But yes, there is a lot more work to do for us going forward, and we are working on that. In fragrances, I think we are expanding our portfolio. There are explosive growth on the lower price band and then the higher price band. And so we are kind of expanding our skin perfume portfolio. We will see some more action in Q4, Q1 and Q2 of the next financial year. So we are hopeful that these businesses also will claim back their rightful growth trajectory.
Must say branded jewelry sales are just looking very, very strong. But a lot of comments that our next guest made in the pre-budget show and a lot of hopes that she'd expressed, some of those have come out to be true. Pranjal Bhandari, Chief India and Indonesia economist at HSBC, joins us right now on the show to talk about her thoughts and takeaways from the budget. Pranjal, great having you as always. Thanks for taking the time out. First, before I get to the numbers, you would have been happy with some of the key announcements in the budget, I presume.
Yeah, I think so. I think the general thrust of the budget was good. And, in a way, it was in line with what the government has been doing over the last couple of years. As in, this government is not giving as many handouts or raising current expenditure in a meaningful way. Rather, it is focusing on Capex. Now, Capex also has its issues. It's not like you need implementation capacity. So you have to keep innovating. So it keeps innovating. So sometimes gets it right, sometimes doesn't get it right. But I think the intention is on the right track, that let's focus more on Capex than current expenditure. Because, what happens is Capex doubles up as current expenditure because it creates construction jobs. In fact, I would say we don't have full-fledged rural distress this time because there's so much construction activity going on. And a lot of farmers are getting side income from construction activity. So my sense is that the push on Capex is something that makes me feel that the thinking that we've seen in the pandemic period, I think, that has continued in terms of good quality spending. And of course, fiscal consolidation. That was very much needed. Remember, this is a time when states have raised their fiscal deficit. Public debt has actually increased over the last 2 years. So it was a time for the central government to come back a little bit. The gross market borrowing was lowered substantially. The 10-year bond yields fell. So more resources are now available if there's a private Capex cycle. And the rate, the 10-year bond yield, the cost of getting these resources is also lower. So this is another way, that growth will be indirectly helped.
Yeah, the gross market borrowing. You guys remember Pranjal had told us pre-budget that a number below 15.2 lakh crores would be something that would please the bond markets. We came in circa 14 and the bond market showed their hand for sure. Now, Pranjal, you made a very interesting point about how FY24, pre-budget, you had made this point about how FY24 was a story of state Capex. Somebody made this point yesterday that the announcement that has happened, because we're not trending at the limits for FY24 on the overall Capex either. So effective from the current number, which has been used, to the budgeted estimate for FY25, it's actually a 16-17% growth. And if we take into account that there will be Achar Sahita for month or month and a half, then for a 11-month period, that Capex number is still fairly strong. Would you concur, and would you believe that coupled with the state Capex and this, it's a heady number for FY25 as well?
So look, there are there are a lot of unknowns. I'll just be honest here. The Capex bill for the central government is likely to increase from 3.2 to 3.4% of GDP. Always like an increase in Capex, so that's good. But where is this 0.2% of GDP increase coming from? It's coming from a fund that has been earmarked for any sector which may raise its hand as the year progresses, asking for more funds. It could be railways, it could be roads, it could be ports, it could be anything. So the government has just put aside some money but not allocated it specifically. This is very different. I would say it's also innovative because this is just an interim budget. And also the year has a lot of uncertainty. The global environment is very uncertain. So they'll earmark it appropriately as the year goes ahead. But this is a new innovation that they just put some money aside. So we don't really know where that will go. That's one. The other is the partnership with states. The center has understood that the states have, implementation supremacy to center because they're closer to the ground. And in the spirit of that, they started the state loans, which have been maintained at 1.3 trillion. But if you notice, they've also increased the amount of Capex they give to states. Capex money they give to states under centrally sponsored scheme. So this whole partnering with states for Capex, I think, is a theme that started 2 years ago and has been strengthened over time. So these are some of the good parts. But at the same time, you have to also notice that outlays to roads, rails, one or two sectors are a little lower. Also, because we're now going into the election period, a lot of approvals are not happening. So right after election, we'll have to wait for some time for the approvals to pick up. So my sense is we could see some softening on Capex in the next couple of months. But for a year as a whole, FY25, I agree with you. I think it's a strong story.
Pranjal, good morning. Tamanna here, and great to speak with you on NDTV Profit. I want to get your take on the entire narrative and concerns about what can the budget have done or what should the government do to improve consumption at the rural level? You said distress is lower, perhaps as an outcome of the huge Capex push and infra building, etc. But do you think more needs to be done? Because that story is playing out when we talk to FMCG companies, etc. Apart from high-end discretionary spending, the rest seems pretty muted.
Yeah, I think this has been the main quibble of equity markets. And since morning, the calls I've had have asked exactly the same thing. What did the budget do for consumption? The truth is that the budget of this particular government doesn't end up doing too much directly for consumption. I think that has been their forte. They've tried to increase Capex expenditure, lower current expenditure. So honestly, they've done as much or as little as they were doing compared to a previous year. But I think indirectly the consumption support is there. On the back of this, the housing plan, 20 million new houses over the next 5 years. In fact, if you look at the Capex outlays, housing is one of the sectors in which the outlays have increased. So I think through this whole construction push, my sense is they want to get people to go out, work in construction sites, earn money there. And then that becomes a part of, the consumption in rural India. I think that is the direction they prefer than increasing outlays in PM Kisan or Narega in a meaningful way. So, in fact, if you look at rural spending over the last 2-3 years, it's been softening every single year. So this government doesn't believe so much in cash transfers as it believes in Capex and then Capex increasing incomes.
That's something most economists are actually happy about because you're leading to longer-term benefits. One point from me, Pranjal, and this is sort of a debate going on since this morning with guests we've been speaking to inside the studios as well, is this push to developed nation status by 2047. I'm bringing it up because the finance minister has said you'll see more details on how that happens in the July budget. We had Jahangir Aziz this morning saying it's looking difficult to achieve that on a per capita income parameter by 2047. Your take on this developed nation status goal?
Look, it's a great aim to have. It's a great objective to have. 2047 is really far away, so we'll have to see how it pans out. But I do think India is in a good position for the next decade. And I'll tell you why. We all talk about China plus one, but India is not a China story. India is a separate story. What we have is far more services in our GDP than industry. In fact, when China was in the same GDP per capita as we are right now, its share of services was about 10 percentage points lower and share of industry was about 10 percentage points higher. So the mix we have, more services compared to some other nations, may not have been the winning formula for the last decade when there was a lot of globalization in goods happening, but it might be a great formula for the next decade when globalization in goods trade has fallen off, but globalization in services trade continues to rise, particularly driven by technology. So for us, we are well hedged, right? We have goods trade and we have services trade. So we are well hedged, and I think it's a winning formula for now, at least for the next decade. So with that, and we make the right steps, we do the right reforms. We also pull up what I call old India, which is agriculture, small firms, and I think we have a good stab at increasing India's GDP to developed country levels. GDP per capita, though, is going to be much harder, and I would agree with Jahangir on that.
Okay, Pranjal, since 2047 is too long and you've given your view for the decade, let's talk about FY25. Now, you've told and you've analyzed that how services exports were maybe not as heady, and that has probably been a problem, if you will, relative to the past years. And correct me if I'm wrong here. Is there a sense that in your estimates for what could happen in FY25 or calendar year 24, as the case may be, there are some changes to what's happened in 2023 or FY24, which are meaningful on a YOY basis?
So which sector, sorry, are you talking about?
Services.
Yeah, so look, I think what we've seen in terms of services exports, so there are two things. Let me just talk about services trade and domestic services. In terms of services trade, we had a huge shot in the arm as India became an exporter of professional services, right? Earlier, we were a call center, then we became a software services provider, but now we sell all kinds of professional services like legal, HR, accounting, research, design. And I think this is a story that's a multi-year story. As in, India is the one country where an MNC can set up a captive center and from one room, have an engineer, a doctor, accountant, a lawyer, and thousands of each. So I think we have a lot of benefits there, and that's a story that will continue. In terms of domestic services, my sense is that's where growth will come from in the next year. Because if you look at the last GDP number, manufacturing is already 30% higher than pre-pandemic levels. But services is only 17% higher than pre-pandemic levels. So I think there's a lot of catch-up in services that has not yet happened. And my sense is the growth will, really come from there. If you look at the last few PMI numbers, I think I also mentioned it last time, it is showing that, services activity is rising more quickly now. So I think the next couple of months, I feel secure about growth because there's a lot of growth coming from services right now.
Pranjal, just one last question, there is some thoughts around how this budget will preach to the rating agencies as well. We spoke to Moody's, they said that no upgrade for now, but it's a strong presentation nevertheless. What's your view on the rating side?
Mm-hmm. Well, that's a tricky question. My sense is we have to look very carefully at the public debt number. In the last 2 years, it's inched up a little bit. I think Moody's and all other agencies should look at that, right? Because, that's what they really look at. And once I think India starts showing public debt falling, first stabilizing and then falling a little bit, I think then we can start thinking about a ratings upgrade. I sort of don't see it in the next year.
Fair call. Pranjal, we'll leave it at that. Thanks so much for taking the time out and being with us. Really appreciate your time this morning.
Great. Thanks for having me.
The pleasure is entirely ours. Okay, move on from the macro to the micro. And Paytm is down 20% yet again. Harsh, who's been tracking this very closely, joins us with some trade details and any other takeaways that he may have gleaned from the last time that we spoke to him until now. Harsh.
Well, yes, Niraj. So, this is roughly 17,500 crore of market cap wiped off, 36% down over day before yesterday's close. It's a hammering that the stock is getting, and not surprisingly, it seems that the RBI action is virtually like the payment bank license itself being revoked. It's essentially that, because when we are looking at the management commentary, of course they are continuing to suggest that they will continue to retain customers, but one will have to look out and try and judge whether they will actually be able to do that. And let me quickly take you through a few pointers from the con call highlights which stood out for me. One is Paytm is going to finalize 1 to 2 banks which they can tie up with in order to replace Paytm Payments Bank as its banking partner. Mind you, it owns 49% in Paytm Payments Bank, and Paytm Payments Bank is the associate company of Paytm. So now no longer that 49% holding holds or does not hold much relevance anymore, at least. When I'm looking at what the founder himself is saying, he's calling this a speed bump in respect of Paytm Payments Bank, and he's calling it a big speed bump. Now, they are able to continue to do business on the wallet front if they tie up with more banks. With regard to impact, 300 to 500 crore EBITDA impact is what the management has come out and stated. But the EBITDA for 9 months FY24 is 460 crore. This is EBITDA before ESOP. The ESOP itself is roughly 1100 crore for the 9 months ended FY24. So the knock is going to be very, very large. And the path to profitability is still now even more cloudy. So we're not really sure as to how profitability will evolve. The lending business remains unaffected, but over the next month or so, they will not be doing any loans. So Q4 FY24 numbers will have an impact of that. Of course, lots to look out for and a lot of questions unanswered. One, is that 300 to 500 crore EBITDA impact permanent, or is it temporary? Once the banking license is received again, or deposits are again allowed, new customer onboarding is allowed, will that change? Will that 300 to 500 come back? There is a temporary impact of not disbursing, of not distributing loans. What will that impact be? What impact will it have on customer sentiment? Not yet clear. And what has caused these implications? That continues to be in limbo. We're not sure as to what that is.
Okay, Harsh, thanks for that. And that's the issue with Paytm. Of course, you heard Vijay Shekhar Sharma earlier as well on the con call and on the channel as well. So the problems continue for Paytm. We need to slip into a quick break. On the other side of the break, we'll be back with the management of Max Healthcare to decode their quarterly numbers.
Welcome back. You're watching India Market Open. Let's go across to this conversation with Abhay Soy of Max Healthcare. I spoke with him on their quarterly numbers, where the big takeaway, of course, being that their average revenue per bed has gone up significantly. Can that sustain? Listen in to what he says. All right, we're talking about the quarterly numbers of Max Healthcare today. The stock has seen a pretty good run-up, and the numbers on the face of it look quite good. At least the net profit and revenue numbers, the top line and bottom line looks decent. Revenues are up 14% for the quarter year on year at 1689 crores. The EBITDA also has improved a little better than Bloomberg estimates as well. That's up 12%. Net profit is up 26%. A bit of compression in the margins, down about 40 basis points for the quarter. What are the highlights for this quarter and the strategy going ahead? To speak on this, I'm joined now by Abhay Soy. He's MD of Max Healthcare. Abhay, thank you so much for speaking with us here at NDTV Profit. Great to have you on. Your average revenue per operating bed, your RBOPs look healthy this quarter, up about 15%. I am assuming that's what's contributed to your top line as well. Can you break that down for us?
Yes, so, the factors pushing our RPOB, and this has pretty much been in line with what we've seen throughout the year. But the factors which are propelling RPOBs are, one is insurance, higher incidence of insurance that payer group for us is going at 25 to 27%. You'll appreciate the fact that when people buy insurance policies, they pay pretty much same amount of premium. Whether you go to ABC nursing home or you go to a hospital with a stronger brand, you're less price sensitive. So that's something which has been working for us. Other than that, there's been higher growth in oncology as a segment for us. This is a higher RPOB business relative to other segments, other specialties that we have. And it's had an inordinate amount of growth. Other than these two factors, international patients has grown at a CAGR of 25%. They propel RPOBs because the higher RPOB business. And then finally, I think if you look at specialties, robotics, for example, we pretty much doubled in the last 1 year. That is something which has propelled RPOBs as well. So all these are fairly secular. These are not one-time sort of factors. These are fairly secular factors which have propelled our RPOBs, and at least I expect them to continue going forward as well.
Including the kind of growth you've seen from international patients, that seems fairly robust. You think that will sustain?
Absolutely. So this has been a quarter on quarter, I think, for the last 8 quarters or 7 quarters. So, this is not just this quarter that we've grown by 25%, but we've grown 25% in the previous quarter and the previous quarter and the previous quarter as well. So, yes.
So you see that sustaining?
No, absolutely.
Okay. You talked about the impact of greater insurance coverage, reducing price sensitivity of patients, because if they have that coverage, they might as well go to a branded hospital. I'm trying to understand what the recent regulation changes, which allow patients to go to and to avail of cashless treatments, even if the hospital is not in their insurance network. What does it mean for you? Does it improve this factor? Is it a bit of a pain point? Because you have to provide cashless hospitalization and then do the job of getting the reimbursement. So can you just explain that in terms of impact?
Well, first somebody needs to explain the policy to me, because one morning I woke up and read the same newspaper article that everybody else did.
Yeah.
I have yet to hear regarding any policy or any overture from any insurance companies regarding this, because even the article I read, honestly left me with a lot more questions. How does it work? So, whatever my pricing is, the insurance company will have to, provide cashless assistance to patients on this. We don't need to sign up for it. It's automatic. I mean, that's great for hospitals, but, frankly, I don't see how this whole thing works, right? So it's a very nice, sweet article early in the morning, but somebody needs to fill in a lot of important blanks there and let people know what it is.
No, so fair enough, though it is something that is now going to roll out. You're absolutely right to say that we need more details on how exactly it will work on ground. But I'm trying to understand, in terms of implementation, is it disruptive for you and for the space? Or is this now going to be the responsibility of the TPA?
No, I think, first and foremost, if, and I'm just hazarding a guess, I think the intent of whatever the article is to make it smooth and make it relatively efficient and easier for the patient and for the customer. I think the minute you do that, if you make it more efficient, more patient for the person, more efficient and more smooth for the patient, then it works well for pretty much everybody. The question is, this is not one against the other. I think it is about aligning all interest groups and aligning all the ducks in order to provide a seamless service to the patient. So, from that standpoint, you can't critique what the intent is. But the question is, how do you, there is a process of onboarding hospitals by insurance companies and vice versa. And that, process is not something which can necessarily be short-circuited in this manner because, how does it work? Anybody can charge anything and then gets away with it. It's the same rate for different hospitals across this thing, etc. So, one doesn't know, like I said, what this is all about. It's all about execution of the intent that comes down to.